and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The new financial year has begun and it's one that will see several changes in the way you manage, compute and file your taxes. It's always a good idea to start early rather than wait up till March next year. So this week we bring you the Money, Money, Money guide to simple tax planning. Everything you need to know with respect to personal taxation in FY 2018. Mayur Shah, partner at EY, is our tax guru for this purpose today. Mayur, great to have you on the show. You are our tax friend, old friend of Money, Money, Money. Now, I'm just going to sort of jog memory back because we discussed a lot of this around the budget, but the fact is this is the year in which a lot of this is operational. So let's start from the beginning. The kind of changes that we're going to see with respect to personal taxation, right from the small tweaking of the tax slabs that the finance minister announced.
So yes, there is a change in the tax rate for the income which falls between 2.5 lakh to 5 lakh. Tax rate has been reduced from 10% to 5% for this year, as a result of which the tax saving for every taxpayer will be 12,500 rupees.
In a year. And that is if assuming that you've maxed out all your limits under ATC, you've taken full advantage of the insurance premium, etc., the tax rebates that are offered over there.
So after deriving taxable income, after giving all the benefits, exemptions, deductions, certainly that's where you save 12,500 rupees.
And there's a minor change in the rebate itself, the basic rebate that's offered to the lower strata of the taxpayers as well, right?
So earlier, the rebate which was there was of 5,000 rupees and earlier tax rate was 10%. Since the tax rate has been reduced from 10% to 5%, the rebate has been reduced by 2,500 and this has now become from 5,000 to 2,500. So exactly half, given the rate has been reduced by 50%.
Okay, so that's the simple calculation with respect to the tax itself that you have to pay and the outgo therein. Let's move to some of the other aspects. There were lots of tax-related provisions with respect to housing in this budget. And for the ordinary taxpayer, the provision on rent, if you are paying rent above 50,000 rupees, there was a change there. There was an element of withholding tax of sort, right?
Correct. So now every person who is paying rent annually more than 50,000 rupees per month, that person is required to pay TDS or deduct TDS and pay to the government treasury. Now this has to be done once in a year, not every month one has to pay, deduct. One aspect which is kind of bothering everyone is that what if I go to a hotel and I spend, say on rent more than 50,000? What happens to that?
To a hotel?
Yeah, to a hotel.
Okay. And
certainly there are old circulars which seems to indicate that rent which is paid regularly, in such case you are required to deduct. Can one take advantage of that or not? Something which will result into a debate on a going forward basis.
So one more provision on housing, because the manner in which capital gains is being computed, I think there were some changes there as well. So how does it change life if anyone is planning to sell a house, let's say this year, if there is a capital gain on that investment or on that sale, how will the tax treatment be meted out?
So we know what happens. There are, apart from capital gain, there are other changes also in the law. The one thing is that if immobile property is being sold and it is being held for more than 3 years, then it will be regarded as a long-term capital gain and long-term capital assets. Now this 3-year period has been reduced to 2 years. So if a person is holding property for 2 years or more, in such an event, it will be sale or a transfer of such property will result into a long-term capital gain rather than short-term. Once it results into a long-term capital gain, you have an advantage of utilizing various exemption provisions, such as investment in another property or investment in bonds, etc. So, that gives an added advantage if it is being regarded as a long-term.
So, you can offset your long-term capital gains tax liability.
Correct. Secondly, it reduces your tax liability. If it is a short-term capital gain, then it will be taxed either at a maximum marginal rate or at a slab rate which a person is governed by. But in long-term capital gain, it will be 20% of the gain which will have to be paid as a long-term capital gain tax.
Okay.
So that is an advantage one can run with.
So you have to pay 20% long-term capital gains on the sale of this property, but there are certain offset routes. And in fact, one of those offset routes the government promised to increase or broaden, I think, was investment in bonds, because up till last year, you had to invest only in, I think it was NHAI bonds and REC bonds?
Absolutely right. So now, what provision has been brought in, that Central Board of Direct Taxes can notify various other bonds, and one can avail the benefit of in making investment in those bonds. Maximum deductions or exemption which is available under this is up to 50 lakh rupees for such investments. And up to 50 lakhs, it is going capital gain will be exempt from taxation then.
Okay, we might have more bonds being added to the list of the bonds that one can
That's
invest in.
right.
But any other way of saving on this long-term capital gains tax?
Certainly, if you make investment in property, or if you have any capital losses to be carried forward, and you can set it off against that. So those are the usual methods which are available for saving on a long-term capital gain tax.
Mayur, one more point on housing, and this one created quite a furore, right? Has there been any back and forth on this at all or not? I'm talking about the fact that earlier, if you had a second house, whatever you were losing on it by way of the interest payout, etc., you could offset that against the rest of your tax liability. Now, this is going to be completely taken away, or I think limited to just, what, 2 lakh rupees?
That is correct. And yes, it has created a various kind of ruckus in the entire salaried class employee, because that was the only tool where you think of investing and making sure that upon retirement you can earn a good sum of money then. So what used to happen is that if a person has a second property, and generally it's being let out, the second property is always or generally being bought after taking loan from various institutions. What happens when a property is let out and any interest they paid thereon, even if you incur a loss on account of that, this loss could have been set off against any other income, whereby you are reducing your tax liability, given that your total income gets reduced because of the loss on house property. Now this loss, which can be offset, is being restricted to 2 lakh, like self-occupied property. There is no exemption for interest deductions, which was limited to 2 lakh for self-occupied property. Now here, the restriction will also apply to property which are being let out or deemed to have been let out. Right? What it does is that if any interest cost incurred beyond 2 lakh, which could not be set off against the rental income which has been collected, such loss needs to be carried forward for next 8 years. And any income which is arising from house property, you can set it off. However, you can't set it off in the current year's income. So that is the difficulty which has been created. Now there were several representation has been made. I think there are no changes, or not I think, I am sure that there are no changes which has been made under the final enactment.
Okay, so it looks like the taxman is not relenting, not on this one at least. Well, we'll take a break on that note. But on the other side, another important provision. The government has said that if you've not paid STT or securities transaction tax on shares that were acquired in earlier years, then you will no longer get the benefit of the long-term capital gains tax regime with respect to equity. What does that mean? Is that going to increase your tax outgo? We'll ask Mayur.